So, can you actually pay your taxes to the IRS using a credit card? I know it sounds like a total financial myth, right? Or maybe even a terrible mistake, because we've all been taught to never mix tax debt with plastic. But what if I told you that for some savvy folks out there, swiping a card for the IRS is actually a highly lucrative, calculated strategy?
Take this real Reddit user on the Fat Fire forum, for example. This person is planning to pay a massive $1.3 million tax bill entirely on credit cards. Why in the world would they do that? Well, they're leveraging the grace period for a free short-term loan, and they're racking up absolutely unbelievable rewards points. This isn't just theory, folks. People are doing this right now to turn a painful tax bill into a massive financial win.
Welcome to The Explainer. Today, we're going to demystify exactly how you can use a credit card to pay your taxes. Whether you're a complete beginner to this process or you're just looking to optimize your current setup, we're breaking down the financial math, the exact steps, and the critical rules so you can decide if playing with plastic this tax season is the right move for you.
Here is our agenda for today. We'll be covering the credit card tax hack, weighing costs versus rewards, how to make the payment, pro tips and strategies, and finally, pitfalls to avoid.
All right, Section 1, the credit card tax hack, turning a tax bill into a financial benefit.
Right off the bat, you're facing a core dilemma here. The pros, they're highly appealing. You can earn massive credit card rewards like cashback or airline miles. You can dodge costly IRS late penalties if you're a bit short on cash come tax day. And you can create a short-term cash flow float while you wait for your credit card bill. But you absolutely have to weigh those against the cons. We're talking unavoidable third-party processing fees, the risk of high API interest if you don't pay that balance off in full, and potential damage to your credit score if you max out your available credit. Let's get into Section 2. Weighing costs versus rewards. The math made simple.
First thing you really need to know is that the IRS doesn't process these payments directly, and they don't keep any of the fees either. They use authorized third-party processors. Now, while debit cards charge a flat fee of around $2, credit cards charge a percentage-based convenience fee. Currently, PayUSA tax is at 1.82%, Pay 1040 is 1.87%, and ACI payments sits at 1.98%. Just keep in mind, these fees are totally unavoidable.
So the whole trick here is finding what we call the arbitrage gap. That simply means your credit card's reward rate has to be higher than the processor fee you're paying. Let's say you're using a card like the Bank of America Premium Rewards Card, which can earn up to 2.625% cash back for certain qualifying customers. You'd compare that to, say, the Pay 1040 processing fee of 1.87%. Let's run that exact math on a hypothetical $100,000 estimated tax payment. Your credit card earns you $2,625 in cash back, right? But you got to pay $1,870 in processing fees. Subtract the fee from the reward, and you are left with exactly $755 in pure free cash, literally just for clicking a few buttons instead of writing a check. That right there is the power of a positive arbitrage gap. Moving right along to Section 3, How to Make the Payment, your step-by-step guide. The good news is, executing this is actually incredibly simple. You don't need a paper voucher like a Form 1040-V or anything like that. You just go to the IRS website and pick one of their approved processors. You'll enter if you're paying personal or business taxes, the tax type, and the tax year. Then just input your credit card info, review the processing fee, and hit Submit. But here is the absolutely crucial step. Save that digital confirmation number. The exact date the charge is authorized counts as your official proof and date of payment.
You also need to seamlessly align your payments with the IRS timeline. If you pay estimated taxes, you've got strict quarterly deadlines, January 15th, April 15th, June 15th, and September 15th. Annual returns and extensions generally fall on April 15th. You've got to ensure your card is charged on or before these key dates to dodge late penalties from the IRS. And remember, the authorization date is what matters, not when the funds finally settle at your bank.
Now be aware, the IRS strictly limits how many card payments you can actually make. You can't just swipe your card endlessly. For an individual 1040 return, you get 2 card payments per year. For estimated taxes, it's 2 payments per quarter. But here's a neat pro trick. Savvy taxpayers have figured out that these limits are typically enforced per payment processor. That means if you max out your 2 payments on Pay 1040, you can usually just jump over to ACI payments to make 2 more, effectively doubling your allowed transactions.
All right, Section 4, Pro Tips and Strategies, Maximizing Your Returns.
Let's look at Scenario A, which is incredibly popular, hitting a sign-up bonus. Premium travel and business credit cards often offer massive sign-up bonuses, sometimes worth thousands of dollars in travel. But they usually require you to spend $10,
$15,000, or even $20,000 in the first 3 months. By utilizing your mandatory tax burden, you can instantly hit that minimum spend requirement with a single swipe, unlocking a massive bonus that completely blows that processing fee out of the water.
Then there's scenario B, the 0% APR flow. Look, if you owe the IRS but lack immediate cash, the IRS will gladly put you on a payment plan, sure, but they currently charge an interest rate around 8%, plus setup fees. Instead, you could open a credit card offering a 0% introductory APR for 12 to 18 months. You just pay the upfront 1.82% processing fee, and boom, you have over a year to pay off that tax debt completely interest-free.
Now, you might be wondering, what about taxes on the rewards themselves? Well, according to current IRS guidelines, rewards earned through spending, like your standard cashback or miles, are viewed as non-taxable rebates. They're essentially just a discount on what you purchased. However, if you receive a no-strings-attached bonus like cash just for opening an account without a spending requirement, and it's over $600, that is actually considered taxable income, and you'll likely get a 1099 MISC form in the mail.
And here's an absolutely brilliant tip for the entrepreneurs and freelancers tuning in. If you are paying business taxes, that pesky credit card processing fee is actually classified as an ordinary and necessary business expense. That means the fee itself is tax deductible. This effectively lowers your net cost of using the card, making the whole rewards arbitrage strategy even more profitable for business owners.
Finally, Section 5, Pitfalls to Avoid, Protecting Your Credit and Cash.
First and foremost, never ever carry a balance on a card with a standard high APR. Earning 2% in cashback is entirely pointless if you're paying 22% in credit card interest, right? Second, beware of maxing out your credit limit. Your credit utilization ratio makes up 30% of your FICO score. Maxing a card to pay taxes can temporarily tank your credit rating. Third, always ensure you're using the official IRS payment processors so it codes as a standard purchase. If a sketchy third party codes it as a cash advance, you'll get hit with immediate, astronomical interest rates. And lastly, do not miss those deadlines.
So, the ultimate question you really have to ask yourself is this. Are you leaving money on the table by sticking to your checking account? Or is playing with plastic and the IRS just too risky for your financial habits? The math absolutely works, but only for those disciplined enough to play the game perfectly.
Please keep in mind this explainer is for general educational purposes. Because tax and credit situations vary wildly, always consult a certified tax professional before making your next big move. But before you file this year, take a good look at your tax bill and ask yourself, are you just going to pay it, or are you going to make it pay you? Thanks for joining us.